Hi and welcome everyone. Bitcoin recently hit a new all-time high. And if history is any indication, its price could soon go parabolic. This presents a massive opportunity. But to capitalize on it, you need to know what you're doing. You need to understand the fundamentals of Bitcoin trading. That's why today, we're breaking down exactly what Bitcoin trading is, giving you a step-by-step guide on how it works, including how to identify key levels and manage your strategy. Let's get started. What is Bitcoin trading? At its core, Bitcoin trading is the act of speculating on Bitcoin's price movements. Unlike HODLing, where you buy and hold for the long term, trading involves actively buying and selling to profit from short to medium-term volatility. It's a complex skill that combines analysis, discipline, and risk management. To get started, here are the 5 essential steps every new trader should understand. Step 1. Define your trading style and setup. The first step is to decide how you plan to trade, as this determines your setup. If you're planning on trading frequently, every day or every week, you'll likely be using stablecoins like USDT or USDC on an exchange, as they are the most liquid trading pairs against Bitcoin. If your exchange supports direct fiat deposits, you can use that instead. If you're planning on making trades less frequently, say, once a month, you need a secure crypto wallet to store your Bitcoin between trades. As a rule of thumb, you should never keep crypto you're not actively trading on an exchange due to potential security risks. Step 2. Identify the long-term trend. The second step is to assess whether Bitcoin is in a long-term uptrend, a bull market, or a long-term downtrend, a bear market. An easy way to do this is to look at the charts on weekly or monthly time frames. Identifying the overarching trend is crucial because it tells you the general market sentiment. In an uptrend, most traders are long, betting the price will go higher. In a downtrend, most are short, betting it will go lower. This sentiment creates predictable volatility. In an uptrend, it's common to see sudden 10% dips before recovery. In a downtrend, you'll often see sharp 10% spikes before another drop. Being prepared for this volatility is key to not panicking at the wrong time. Step 3. Find key support and resistance levels. The third step is to identify zones of support and resistance on shorter-term time frames, like the daily or 4-hour chart. Support is a price level where buying interest is historically strong enough to prevent the price from falling further. It's a lower range where the price has previously clustered. Resistance is a price level where selling pressure has historically been strong enough to prevent the price from rising further. It's an upper range where the price has clustered. If Bitcoin is rallying towards a known resistance level, chances are it will be rejected and pull back. Conversely, if it's crashing towards support, it will often bounce and rally. In a strong uptrend, Bitcoin often breaks through resistance, which then becomes new support. The opposite is true in a downtrend. Pro tip: zones on longer time frames, weekly, monthly, are stronger and more reliable than those on shorter time frames, 1 hour, 15 minute. Step 4. Use indicators and patterns. The fourth step is to use technical indicators and chart patterns to help signal potential short-term trend changes. One popular and useful indicator is the Bollinger Bands. If the price is above the upper band, the asset may be overbought and due for a pullback. If it's below the lower band, it may be oversold and due for a bounce. The middle band, a moving average, often acts as dynamic support or resistance. When the bands squeeze tightly together, it often foreshadows a major price move, known as a Bollinger Band squeeze. As for patterns, some of the most common in Bitcoin trading are bull flags. A sharp rally, the pull, followed by a slight consolidation lower, the flag, before another breakout rally. The measured move is often the length of the pull projected upward from the breakout. Double tops and bottoms. A double top, M shape, is a bearish reversal pattern often seen at short-term peaks. A double bottom, W shape, is a bullish reversal pattern often found at short-term lows. Remember, these patterns are used by many traders, so it's often prudent to take profits slightly earlier than your calculated target. Step 5. Understanding market cycles and sentiment. The final step to understanding Bitcoin trading is to learn about market cycles and sentiment. Bitcoin has historically followed a rough 4-year cycle, driven by its halving event. This cycle consists of a bull market, 1–2 years of a general uptrend, a bear market, 2 to 3 years of a general downtrend. We are currently in the bull market phase. During this time, you'll see multiple local tops, short-term highs, and bottoms, short-term lows, before a final cycle top, the highest price before the bear market begins. While technical analysis is vital, it can break down at these major tops and bottoms. These pivotal moments are often driven by extreme market sentiment and powerful catalysts. Extremely bullish news can create a cycle top as everyone rushes to buy, while catastrophic news can create a cycle bottom as everyone panics and sells. Understanding this bigger picture helps you contextualize the short-term moves you see on the charts. Key trading tips to remember. Before we go, here are 5 crucial tips for anyone interested in Bitcoin trading. Manage expectations. Statistically, many active traders don't outperform simply buying and holding Bitcoin. Trading is a skill that requires immense practice and discipline. BTC versus altcoins. Bitcoin's massive market cap means its percentage price moves are usually smaller than those of smaller altcoins. The potential rewards are different. The power of holding. Bitcoin has been the best performing asset of the last century. For many, a simple strategy of consistently buying and holding, stacking SATs, is the most effective. Knowledge is power. Even if you don't trade, understanding these concepts helps you understand market movements and make better long-term decisions, like when might be a good time to take profits for a life goal. Bitcoin doesn't exist in a bubble. Bitcoin's price is often correlated with other risk on assets like tech stocks, the Nasdaq, and can be inversely correlated to the US dollar index, DXY. It pays to look at the broader market. With all of this information, you now have a solid foundation for understanding what Bitcoin trading is all about. It's a challenging but fascinating field. Remember, this is for educational purposes only. Always do your own research and never invest more than you can afford to lose. Good luck and thanks for watching. If you like our video, do subscribe, like and share as a motivation for us to produce more videos.